Hello, accounting students. We are currently working on Chapter 14, Accounting for Uncollectible Accounts Receivable. And in Lesson 1 of Chapter 14, we learned how to estimate which accounts for the business would potentially become uncollectible. And in this lesson, we're actually going to write off an uncollectible balance, and then we're going to look at what would need to happen if the account that you wrote off actually has somebody make a payment to it, and what we would need to do to make sure that the credit history and the account is correct, then that would reflect a future payment. So we're going to figure out what to do once the account becomes uncollectible, and then what to do if the customer actually goes ahead and pays in advance. So the two lessons here, you can see the two objectives and what we're going to be doing. All right, so journalizing the write-off of an uncollectible account receivable, we just want to make sure that we understand that when we cancel the balance of a customer account because they don't pay, this is called writing off an account or a write-off. And businesses often refer to write-offs in terms of, hey, we can't collect this money, so we're going to write it off our books. Okay, so here's an example. January 25th, we're going to write off Edmonds Hospital's past due account because we've determined that it's uncollectible. We're going to use memorandum number 58, and the reality is we just don't think that those people are ever going to pay us. And so we're going to get this money off our books so that we're not constantly looking at it and representing it in our accounts receivable. We just don't think they're ever going to pay. So the allowance for uncollectible accounts, we're going to be looking at accounts receivable, and we're going to be looking at the Edmonds Hospital in the accounts receivable ledger. So we can see that the debit is a reduction here in the allowance for uncollectible accounts, and then we're going to credit accounts receivable so that the accounts receivable balance goes down. And then in our accounts receivable ledger, we're going to go ahead then and post a credit to the Edmonds Hospital account so that we zero out their account and we show that their account is zero. Now, internally within our business information, we would want to keep track of the fact that Edmonds Hospital didn't pay us. So we're not going to issue any credit available to them in the future. We're not going to let them buy an account anymore. They didn't pay us. Okay, so in our general journal, we want to make sure we date that we did this on the 25th. The account title is Allowance for Uncollectible Accounts, and we use Memorandum 58. So you can see the amount of debit, and then in accounts receivable, we're going to go ahead and credit Edmonds Hospital. All right, now make sure that we also note in our accounts receivable ledger for Edmonds Hospital that we have now zeroed out that account balance. We're going to reference General Journal page 16 to do that. And you can see that there's a posting to the accounts receivable, the allowance for uncollectible accounts, and then the Edmonds Hospital. Okay. We have reduced the amount of accounts receivable, so we're going to credit accounts receivable for that $639.88. All right, now it turns out about, I don't know, sometime after in March, after we wrote off the balance, Edmonds Hospital actually comes through and pays. Maybe they're slow to pay their accounts. Maybe they had some process where they were short on cash, but they have turned around and paid us. So we need to reopen this accounts receivable amount and the ledger for that particular business, and then we need to actually post the payment. So you can see in our general ledger, we're going to increase accounts receivable, and we're going to increase that allowance for uncollectible accounts. And we're going to go ahead and increase the accounts receivable ledger for Edmonds Hospital. And really, we're just going to go ahead and reverse all of the entries we made in the original posting. So the entries we made on January 25th, we're just reversing them right now so that we can go ahead and post that payment. So the first thing we do is reverse in the general journal, according to memo number 71, the accounts receivable for Edmonds Hospital and the allowance for uncollectible accounts. And now we're going to go ahead and post the cash so that we can post that payment. In the cash receipts journal, we're going to do the accounts receivable credit, and we're going to go ahead and debit cash. Make sure we reference the receipt number. And then we need to make sure we post the general journal entry in the general ledger. We need to make sure that we reopen that account in the accounts receivable ledger for Edmonds Hospital. And we would note that as reopen account. Then we're going to actually post the cash receipt journal entry to the customer account. So, whoops, you can see that that cash receipt we received of $639.88, we're going to post that as the payment to Edmonds Hospital. So in the end, that accounts receivable ledger for Edmonds Hospital still has a zero balance because they paid it, but we reopened the balance, put the money on the account. Now it's zeroed out again based on a payment as opposed to us writing off their balance. All right, why is allowance for uncollectible accounts debited when a customer account is written off? The balance of the customer account is an actual uncollectible amount, and it's no longer an estimate of that uncollectible amount, so we need to go ahead and zero it out. Does the book value of accounts receivable differ before and after writing off an account? And we want to make sure we understand what's going on here. The book value is the same because the same account is deducted from the accounts receivable and the allowance accounts. So the book value doesn't change. We just went ahead and said, hey, this amount that we were allowing for in terms of, hey, we're allowing ourselves to say that this money is not collectible, we actually went ahead and wrote off what we had previously allowed. So the book value in terms of what we think we'll actually collect doesn't change. Why is a customer account reopened when the account is paid after being previously written off? We just really want to reflect the accurate credit history from all of our vendors. And so you want to make sure that you reopen the account so that you know, hey, that vendor paid us. Even though we previously wrote them off, they did come back through and pay us. So we might want to consider whether or not we would be willing to offer them credit in the future and let them buy on account. Now, one of the things that you would really want to think about in terms of accounts receivable would be how long a business should allow a payment to be overdue before they might consider a partial payment and consider that as payment in full. And in terms of a business practice, what businesses might want to do there, hey, if we get an account that's 90 days old or 180 days old, it's 6 months old, would we be willing to accept 50% and consider that paid in full? And if we do, what is the impact on that vendor account in the future? The other thing you might want to consider as a business practice is, when is it beneficial for us as a business to write off the account and transfer it to a collection agency and find out if the collection agency can go ahead and regain some of our accounts receivable for us, and what the benefits of doing that might be to our business. So that's something you want to consider as an impact to the business as a whole, as something that you might be asked about later. All right, so from here, go ahead and do the form online and the work together and on your own for this lesson. Good luck, everyone.